All right. What is up, traders? What's up, tycoons? Super excited for today's video. The market has been pulling back right now. If you've watched some of my videos, we've gone over, some of the different warning signs, right? And really how to read some of the things happening behind the scenes in the market to give you an idea of when a pullback may be coming. Now, I've covered some of these topics in videos in the past, and I'm really going to keep covering them because it's something that can really help give you an edge in the market. And it's not too hard to understand. It's pretty simple to follow once you know what to look for. So, we take a look at the SPX, the S&P 500 index. It's dropped over 100 points here recently, right? And this was the high on Friday. And since then, as I mentioned, it's dropped around 100 points. And we're going to go over how you guys can, spot these drops, spot these potential pullbacks, and when the market is, going to be potentially, going back risk on, and when it's going back risk off, when it's going defensive, when it's going offensive. So be sure to smash the like button, subscribe to the channel if you guys are new, and we'll go ahead and get straight into it. Now, the way that I do this, okay, just to keep it very simple for YouTube, is we're going to break it down three ways, right? Number one is we're going to look at the four pillars, right? I'm going to break that down. What is the four pillars? Why are they important? And what does it mean to you? Number two is also going to be the shift in tone. Now, you can either look at this as, is the market going defensive or offensive? Is it risk on, risk off? However you want to word it. And number three is going to be the percentage of stocks above or below the major moving averages, right? So, that's kind of like a summary right there. Okay. And the first thing we're looking at right here is this is the percentage of stocks above their moving averages, right? So we have the actual S&P 500 index right here. Okay. The white line is tracking these other lines here are just some, moving averages that I like to use, right? We won't get into that, but you can see that it started to pull back here. Now, this one is the percentage of stocks above their 200-day moving average, and you're going to pay attention to the yellow line here. Now, this white line is 0.5, okay? What this symbolizes is 50%. So when it's above here, okay, it's telling you that the percentage of stocks trading above their 200-day moving average is above 50%. This is a bullish signal. Now, take a look at where this happens. This actually happens right here at the most recent bottom, and the market continues to rally afterwards. All right, and this one at the bottom is going to be the percentage of stocks above their 50-day moving average. And you can see that this has been below 50% right over here, right? And we've basically been in a downtrend since that moment, okay? Basically since the percentage of stocks went below their below the percentage of stocks below their 50-day moving average, dropped below 50%. All right, so, for the market to go bullish, right, you need to see this rise above, right? And, for it to, go shorter term bullish, okay, or, show even more signs of bullishness and strength, you want to see the percentage of stocks trading above their 50-day moving average, also trading above 50%, right? The 200-day moving average is, in my opinion, the more important one. Okay, and the 50-day moving average will kind of let you know when things are getting a little bit too frothy or a little bit too oversold. Now, these are the four pillars right here. So you have tech, you have semiconductors, okay, and then you have industrials, and then you have home builders. Now, the reason that we call these the four pillars, all right, is because, the market is largely driven by tech. Okay. Tech is a big factor in the stock market, whether it's the S&P 500 or the NASDAQ, and semiconductors are arguably, the most important aspect of tech right now. Okay. Chips are driving everyone's technology. And then you have industrials here, and you can go into the Dow Jones industrial theory, okay, and just go into the Dow Jones theory. But essentially, if you see the market doing good, you want to also see the industrials performing well also, okay. And the reason being is because if these companies in the S&P are making profit, you want to see the companies that are manufacturing, transporting, and warehousing these goods also performing well, also. So that's what you want to pay attention for. And then the last of the four pillars is the home builders, because this, in my opinion, is a very important sector, a subsector of the industrials, just like semiconductors are a subsector of the tech sector, right? So we'll break that down. And then here, what we have is the S&P 500 on top, and then we have a ratio charts all down below here. We have a high beta stocks relative to low volatility stocks. We have consumer staple or consumer discretionaries versus consumer staples. And then right here, we have the HYG versus IEI. So this is high yield corporate bonds versus short-term bond ETF. This is kind of a way to measure credit spreads in the market. And then we have the XBI down here, which is the biotech sector. And we'll break down why we use this to tell if the market is going defensive, offensive, risk on versus risk off. Now, as always, the content provided on this channel is for informational and educational purposes only, and is not intended to be relied upon as legal, financial, or investment advice. So please be sure to read through the full disclaimer, and we'll really dive into it now. And we'll head on over to my Thinkorswim platform. All right, so we talked about, what are some of the signals here to potentially see this large move coming to the downside. We're going to start off here with the 4 pillars, okay? And we'll start off here on a weekly time frame, just so you can get a grasp of the overall concept. So, the S&P 500, the stock market is not going to be able to make new highs, okay, and break out to new highs when all 4 of the 4 pillars are battling overhead supply, right? It's very clear to see here that all 4 of these at the moment are battling overhead supply, right? Overhead supply here, overhead supply here. We can't break out, as we're still battling overhead supply in all of our major sectors, regarding the 4 pillars. Okay, it's just that simple. So to see the stock market break higher, we need to see all of these break out, retest that supply, and turn it into demand, right? That's what we're looking for ultimately. Okay. And that's our weekly time frame, right? So we can see that we're stuck in that overhead supply. When we zoom down to a smaller time frame, such as the daily, and a warning sign that we went over previously was we were looking at industrials. Okay, so we'll zoom in here and we can see a little bit clearer on a daily time frame, right? This was on the 5th. Okay, so this was basically Tuesday. All right. Industrials had a very, very brutal day, right? You see this huge red candlestick right here, huge red candlestick right here, also on the home builders. This was a warning sign for the market that, hey, even though on the 5th, tech held up, right? We see tech held up and had a positive day on the 5th. All right. And we come over here and we see semiconductors had a positive day on the 5th, a big warning sign that the overall market was showing weakness, even though we saw a little bit of strength in tech, was industrials and home builders absolutely collapsing, right? Huge red day. All right. So that was a little bit of a warning sign to us. We said, hey, well, out of the 4 pillars, 2 of the 4 pillars are really having very, very bad days, right? And looking really rough. Potentially this is a warning sign to us that, hey, the stock market's not about to go higher because we have 2 of the 4 pillars bleeding. Okay. And you can see that tech ended up actually following behind, right? So tech, after these green trading days on the 5th, had 2 red days right after that, 2 red days right after that. Now, of course, today there was a lot of news about, Apple and China, and, we're not necessarily going to cover that, but something I always like to say is that price action often precedes the news. Okay, price action precedes news. So before we even had the news about China, we saw, using our market breadth and market internal analysis and behind the scene analysis, we saw that we were already experiencing weakness in the market. Apple is a huge component of, almost every single ETF, not literally, okay, but there's over 300, close to 400 ETFs, right, that have Apple in them. It's basically the company that almost fits anybody's portfolio, right? Whether you're a value investor, whether you're a growth investor, lots of people have Apple in their portfolio. In the market, gap down today. Okay, so that's the 4 pillars. That's essentially how you want to use them. We'll come over here and go into the percentage of stocks above their 50-day and 200-day moving average. And there's a couple different ways that I like to use this. Okay, so remember, the middle one is going to be the percentage of stocks above their 200-day moving average. And then the bottom one here is going to be the percentage of stocks above their 50-day moving average. And, as I mentioned, there's a couple of different ways I like to use them. One way is for divergences. Okay, so a divergence is simply when the S&P 500, which is up here, is going one way, but we're seeing these indicators here going a different way. So a really good example we can see back in October, actually, when the stock market put in its lows, okay, we can see that we were making lower lows, right? We had a downtrend here, but the percentage of stocks above their 200-day moving average and their 50-day moving average were actually making higher lows, right? Suggesting that, we're actually starting to see a little bit of strength come back into the market, see a little bit of strength come back into the market, even though we're actually making these lower lows, and that it was actually a signal for the bottom here, right? Now over here, what we have is we're making higher highs, right? So we have a high here, we have a higher high here. Here, we're making lower highs on the percentage of stocks above their 50-day moving average. And so that's a little divergence, right? Now, remember what I said about, we really need to see the percentage of stocks above their 200-day moving average above 50% for the market to go bullish, right? If we zoom into various, points in the past, right, and we come in kind of in this zone right here, okay, and we'll try to line these dates up. It won't be perfect, okay, but, we'll try to line these up, and we can see, over here around the 15th, all right, is when the percentage of stocks, started trading below their 200-day moving average was below 50%. This is the 15th right here, and you see we start this downtrend. Now, we don't really get out of this downtrend, right? You can see that we're boxed up in here. We're basically stuck, trading sideways essentially until what happens, right? Until the percentage of stocks trading above their 200-day moving average actually crosses above 50%. After we cross above 50%, that's when we break out and start our next rally and start making higher highs. And so just to go full circle, and if we were to come out and, take a look at, what the market is doing right now, okay, and just zoom in on this, we can see that, currently, we had the percentage of stocks trading, above their 50-day moving average fall below, or their 200-day moving average fall below 50%, right? That fell below 50%. We started to see this tick down, and we said, hey, we need to be cautious of this. Okay, on Friday, we put in a peak here, and then ever since last Friday, it's actually been on a decline and actually fallen below 50%. All right, and we see also here on the first, we peak on the percentage of stocks above their 50-day moving average. That's already below 50%, but we see that's also in a decline here as well. So, these are some of the things that I'm using and saying, hey, well, there doesn't seem to be a lot of strength in the market right now, right? When people say, oh, the market's very strong, how do they figure that out? These are some of the personal metrics that I've found that really help me out, and hopefully you guys, find this video useful. If you are, I definitely highly recommend subscribing to, my newsletter. Okay, I've got a completely free newsletter giving you guys, free investment intelligence, also some free trade ideas and different setups in here as well. There's also a website associated with it, so it kind of puts it in a blog format where you can go back and actually read through, some of the different blog posts that we've had and newsletters that I've sent out in the past. It's a great way to support the channel while also gathering some free investment intelligence. If you're a fan, if you're a fan of, free valuable content, you're definitely going to enjoy the newsletter. Now, let's go back into our chart over here. Okay. Anyways, so back to our charts here. All right. And this is, one of the ways that I like to measure, is the market going defensive, offensive, risk on, risk off. Okay. We'll start at the bottom. We'll go bottom up this time. Remember, red line is going to be biotech. Biotech is arguably the most risk on asset class. Okay. Being that oftentimes you're investing in completely profitless companies, right? You're investing in companies hoping to fund them, right? That they get some type of FDA approval, come out with a new drug, get some type of patent. Okay. And eventually in the future, that company gets profitable. So that's why it's, in my opinion, arguably the most risk on asset class. So when you see this going down, it's a sign of the market going risk off. When you see it going up, it's a sign of the market going risk on. Okay. Let's go ahead and show you guys a visual real quick. Remember, the S&P 500 is up here on top. What do we see here? We see a low. We see a lower low. Okay. So lower lows here. And this is, again, heading into the October bottom of the stock market. Okay, that's a really ugly arrow, but you get the point. And what do we see here on our biotech ETF? We see a low, and then we see a higher low. So we see the market actually going risk on. Okay, again, another divergence where we're seeing lower lows and we're seeing the market going risk on. And this is right there in that October timeframe. All right, we talked about that divergence with the percentage of stocks above their 50 and 200-day moving average, also showing signs of the market having strength and going risk on again versus risk off, going more offensive, going versus defensive, via that indicator. Okay, this is HYG, IEI. Okay. This is high yield corporate bonds versus, basically your high yields versus short-term treasuries. So this is kind of a way to measure, credit spreads. Essentially, this also wants to be following the stock market. Okay. You want to spot and look for divergences in this chart. Okay. And what do we see? Well, we have a low here. We have a higher low here. And again, we have these lower lows. So each time there's been a significant drop in the market, there's also a significant drop in this chart, right? And if the market's going higher and this is going higher, it's a general sign that things are, in equilibrium and trading accordingly, right? The price's action is moving accordingly the way it should be. Okay. The next one we have here is going to be consumer discretionary XLY versus XLP. So as this chart goes down, this means that consumer staples are outperforming, consumer discretionary. And as this chart goes up, it shows that consumer discretionaries are outperforming staples. Now, if we were to take a look at this, okay, and there's a couple different ways to look at this, right? So we can see here, again, we're seeing a little bit of this divergence where over here, we're making higher highs in the market. And here we're seeing we're making lower highs, kind of a sign that the market is going risk off, right? It's now staples are outperforming discretionary. Staples are generally seen as defensive. And so we're seeing a flight to safety, right? People, pulling money out of consumer discretionary and going into something quote unquote more safe and more defensive into staples. Same thing with this chart over here. This is SPHB. This is your high beta ETF, and then you have SPLV. This is your low volatility ETF. And you're basically using it as a measurement for the same thing, right? So here we're seeing making lower highs while the stock market's making higher highs. So we're seeing this, market drift away, okay, from high beta stocks and actually shift towards low volatility stocks, right? Well, low volatility is generally, more defensive. Okay. So we're seeing the market go more defensive via these two right here. And this was an early, sign of the potential top, right? And then we ended up getting that top, and so what we're seeing now and what we highlighted in the last video, we saw that, the high beta stocks, to low volatility stocks was going down. This is a warning sign signaling that, hey, maybe the market's going more defensive. We talked about staples or discretionaries to staples. And, we said that we need to see this continue to go up, right? And that if this starts to go down, that's going to be yet another warning sign that the market is shifting more defensive and, more risk off. Currently, this is the only one out of all four of our indicators, right? So, if we were to say this is number one, then we have number two, we have number three, and we have number four here. Okay, this is actually the only one that's holding up, right? We see our measurement of credit spreads going down. We see biotech sector ETF going down. And again, we also saw here the high beta to low volatility stock ratio going down. So, 3 out of 4 were showing bearish signs here, and not even necessarily bearish, okay? Because pullbacks are healthy, but we're seeing a rotation, okay? A clear rotation out of more offensive and more risk on into more defensive / risk off, okay? Very simple stuff once you get to, really understand it. And there's lots of ways to use this knowledge, right? Like ZachlyTrades. What is the point of all this, bro? Why you're wasting your time doing all this? Well, you may think that, but in my opinion, this is a really good way to see, hey, is it a time to buy into the market? Or is there signs that, we could experience a pullback and maybe, you can look to actually buy the dip. Okay. That's my personal take on how I'm viewing this market, right? Some people may say, hey, I want to short things. I'm seeing, the market show signs of weakness, showing signs of retreating to safety, showing signs of going defensive and going risk off. Maybe that's when, some people want to short. Maybe you can, use a short position as a hedge. Or, in my particular case, I'm using this as an opportunity to say, what stocks can I find? What individual stocks can I find to potentially buy the dip on? Being that I'm seeing the market, shift right now, what are some names that I want to get into? Okay. We'll throw in an added bonus here and go into some, seasonality real quick. Okay, we'll take a look at the seasonality projection for the S&P 500, and we can see, this is, September over here, and we see that we usually get a bottom sometime around, the end of September and October, and then we start to see the market rally back up again. right? If we were to look at this, and that's a seasonality projection, we have this chart right here as well, that gives you, you know, the historical average, right? So this is typically how the S&P 500 performs. And again, we're seeing that pullback, okay, into September, and then right around October, you know, seasonally, and, you know, historically, we start to see a little bit of a bottom and then rally into the market. So again, we talked about there's different ways to use this information, you know, so you can be someone trying to short the market, right? And you know, catch that pullback and profit off of the pullback, or potentially hedge, or you know, you can be someone potentially looking to gather positions for what appears to be the next rally, right? And once you start to combine all of this knowledge together, you know, you'll really start to see how price action tends to precede news, and oftentimes how it, you know, the bearish articles come out when the market's red, you know, the bullish articles come out when the market's green, and it's kind of like they've been saving this news all along, you know, so that's going to be it for today's video. You know, screenshot this, okay? You know, and you can figure out how to, you know, set up all of these different indicators, all of these different measurements and metrics that I use to, you know, measure the market basically and look for strength or weakness. And I think it'll help you guys out a lot.